Good morning. So when I was thinking about preparing for this presentation, I thought I would talk about generally investing in the Indian stock market, but I changed my mind and decided to talk more relatively about investing in India's stock market in the context of what has happened recently in the US election, and the subsequent rally in US stocks and the sell-off in the bond market. So I'm sure you guys have noticed after the election, US stocks have rallied significantly and the US bond market has sold off. So US bonds, which had been in a bull market for almost 30 years, the thinking now is that they might have entered a bear market. And yields in US bonds, the 10-year has increased significantly. So the 10-year yield on the US bond is now at 2.3%. So what does this mean? What is the bond market signaling to us? So essentially, what the US bond market is telling us is that the US is most likely entering an inflationary period. So up till now, the inflation in the United States was really low, but going forward, if you listen to the bond market, what it's saying is that inflation will go up. And if you think about the policies that the new administration is talking about, it makes sense. So if you look at what they're hinting at, it's more expansionary policies. It's essentially investing in infrastructure, about $1 trillion over the next 10 years. It's cutting taxes, both personal taxes and corporate taxes, which puts more money in the hands of consumers and corporations. It's also bringing money back, repatriating the trillions of dollars that is sitting outside the United States, bringing it back to the country. It's deregulation, especially in the banking sector, which is also reduces the friction in the financial system. That's inflationary. And it's also what they're thinking about doing is erecting trade barriers. How high they will be, we don't know. But nevertheless, that's also inflationary because things that were made for cheap outside of the United States will most likely be now made in the United States at a higher cost. So essentially what that means is, so inflation in the US might go up, interest rates will certainly go up. And that's why US stocks have rallied, that's why the bond market has sold off. And in concert with that, emerging market stocks, emerging market bonds, emerging market currencies have sold off also. Because most of these markets depend on external financing. However, the good thing is, even though India is an emerging market, it's actually quite insulated. The Indian interest rate situation, the monetary policy of the country has actually become decoupled from the United States. And that is very positive for the country. So not only are India's external markets, like the bond market, corporate bond market, or the sovereign bond market, not dependent on external financing because they're quite closed, but also the monetary policy of the country is disconnected from that of the United States. So if you look at this chart, what it's showing you is that up till the global financial crisis, so up till 2008, the US monetary cycle and the Indian monetary cycle were actually quite coupled. And after that, they became quite decoupled. So India's interest rate situation was beating to its own drum, decoupled from the United States interest rate situation. So what you have now is a really interesting situation where interest rates in the US are going up, inflation in the US is going up. However, in India, we're in a situation where interest rates are actually coming down, inflation is coming down. And that is, a lot of it has to do with the recent policies of the Reserve Bank of India after the new Modi government came into power. And the fiscal policies, the monetary policies, the inflation policies, how inflation has come down in India over the last couple of years. So essentially what this is signaling, because these interest rates have become decoupled, is that you are now in an environment where the US is inflationary, US interest rates are going up, but India's inflation and interest rate is going down. So that bodes very well for the currency. So what we're predicting is that the Indian rupee will actually appreciate going forward, because the currency is really, the value, the relative value to the US dollar is really dependent on those interest rate and inflation differentials. So if you invest in Indian assets, like Indian stocks, you'll get a kicker from the currency appreciation that, that will most likely continue given the big difference in inflations and in interest rates in the two countries. So that, I think, is quite positive relative to other emerging markets where you're most likely going to see currencies depreciate and hence assets lose value. So we're right now, as far as the Indian economy is concerned, we're in a situation where the recovery is slow. Nevertheless, as shown in the top chart, nevertheless, the GDP growth there is about 8%, which is the highest in the world. The inflation situation has improved significantly. So inflation used to be 8%, now it's come down to 4 or 5%. The twin deficits that India used to have also reduced due to the policies of the new administration. And interest rates are also coming down. So it's actually a very good time, at least from the macro point of view, to be looking at Indian equities as an asset class. So, so you can invest in Indian equities and get the appreciation of the currency, but it depends on whether you can take the money out, given the situation in the ATM machines these days in India, the demonetization. So, so the demonetization, what actually has happened because of that is consumer stocks in India have actually sold off significantly. So the reason is that consumption in the short term has gone down in India because cash has been withdrawn from the economy. But this presents a very big opportunity because consumption in India is a very secular trend, because consumption is a big part of GDP in India, and even though it has come down as a percentage of GDP over the past couple of decades, it's still at 68%. So this is actually something that China wants to do, where instead of being an investment-led economy, where it's in the case of China, it's 2/3 investment, 1/3 consumption. India is exactly the opposite, where it's 2/3 consumption, 1/3 investment. So over time, even if consumption growth comes down, the aggregate amount of consumption that's generated in the economy will be very high because it's such a significant part of GDP. And the GDP per capita of the country is also growing significantly, which also bodes well for consumption. So this is very interesting because most other countries don't have such high growth. The reason it's so high in India is because it's coming off of a very low base. So the GDP per capita in India is still very low. It's $1,500 relative to China, where it's 8,000, relative to the United States, which is 55,000. So given that it's coming off of a low base over time, as that GDP grows, even at a lower rate, it's still going to fuel consumption in the economy. And hence, the consumer sector, which has sold off significantly recently, I think is a good opportunity for investors to look at. So you can see again in these charts, consumption of white goods, whether it's passenger vehicles or air conditioners or televisions, despite various cycles in the Indian economy over the last 20 years, it's continued to grow quite strongly. This actually is not the case in many other countries, including emerging markets. And one of the key reasons why going forward this consumption will continue to grow is the people say India is the youngest country in the world, but what does that mean economically? So what you have to really look at is, over time, what is the ratio of the change in the working population versus the dependent population? And it's really that ratio that determines how much people spend, how much GDP is generated, how much incomes are generated, how much discretionary income is generated. So if you're in the top left part of this chart, which India is, you're going to do very well in consumption. The older economies like Japan, Korea, they're on the bottom right of this chart. And some of the other emerging markets like China are also not in the top left of this chart. So again, very powerful signal that consumption will be a strong growth sector going forward. However, if you look at the investment part of GDP in the Indian economy, that's actually not doing well. And so if you look at, as shown in the top chart, investment spendings increased significantly in India, leading up to the global financial crisis, and continued on till 2010. But after 2010, it fell off significantly. And the reason for that is obviously the corruption scandals that erupted in India in 2010, and because of that, there wasn't much action going on in government. There weren't any approvals being granted, there weren't any licenses being granted. And so that has taken a long time to start to come back. So after the Modi government came into power, if you look at the top left chart in 2014, there's been a slight rise in the number of new projects that have started, investment projects, infrastructure projects, but it's still very low. And so the top right chart shows that the number of projects that remain stalled is still very high. So it's the investment component that's really pulling down the GDP growth in India, and it doesn't seem like that's going to continue to grow in a significant way anytime soon. But what's really encouraging about this administration is that the drivers for the stalled projects have actually changed. So it used to be that these projects were stalled because of the lack of licenses being granted, because of government bottlenecks. But over the last couple of years, what has happened, the drivers for the stalled projects have changed. It's no longer the government that's causing these projects to stall. It's actually, if you look at the highlighted blue portions, it's really the promoters. And that's because the promoters don't have the money. They're very leveraged. And over time, as the leverage goes through the system and delevers, you'll get these projects start growing again. But this is really the main reason why the investment side of the economy hasn't done well, and where it's going to start to do well over time is when you have the promoters start getting delevered and start getting capital into their companies. So government actually has done a good job if you look at this chart. And just from a bottom-up level, if you compare India to other emerging markets, it stands out pretty strongly in terms of earnings growth over the next 5 years. So India has projected earnings growth of 20% in the next 5 years, Indian companies that is, and also the return on equity. So the dollar of profit you make for every dollar of equity capital invested is also very high in India. It's in the high teens. And that's relative to even the large emerging markets like China. But what's really interesting about the return on equity for these companies, which is what you should look at as an investor, is that the reason corporate ROEs have been going up, if you look at the bottom left chart, is driven by profit margins. So the return on equity of any company is really driven by things like asset turnovers, how much revenue you can squeeze from your assets. It's driven by profit margin, and it's driven by leverage. But in the case of India, the first two, the asset turnover and leverage is not there. Leverage is obviously, people cannot lever anymore because the country is already very levered. And asset turnover is not high because top line is not growing. So there's only so much you can squeeze out. So the way the Indian promoters have been able to generate very high ROEs despite the poor macro environment is by squeezing more profits, is by expanding their profit margin. And that speaks very highly to the managements of Indian companies, especially relative to other emerging markets. So in general, just macro-wise, and especially relative to the US, what's happening in the US, India looks very promising from a top-down basis, especially the consumption sector. The investment sector, not so much, and certainly from a bottom-up basis also. India looks very interesting. So I would encourage you to look at stocks in that country. Thank you.